I know, a dramatic entrance. The CPI potential explosion, question mark, exclamation. I really don't like to clickbait on stuff, but and I especially hate it when there are people that are trying to teach you trading, with you know emotional faces and all those types of things to get you to click it. But I this is something I want to talk on both sides of. I talked about this a couple weeks ago, but the Bureau of Labor Statistics has changed the calculation for CPI. And my belief is, not a trading call, not financial advice, anything like that, is that we are going to write a much lower CPI on Tuesday, Valentine's Day. That's just, and I haven't worked with BLS data as much as probably other people, but just going through some of the changes that they made. Now, I gave a link a couple weeks ago to this, and I'll re-put this link below in the description. But in essence, they've changed the way that they calculate the CPI. And there is just to get some balance to the conversation, I went out looking for people who say, oh, well, this is all conspiracy. This is all, they change these things all the time. This is something that's done quite often, all of those types of things. And that may be true. But one thing I know from working with data for over 30 years and longer with large global organizations is that when you change the operational definition of a measure, you change the measure, and it makes it virtually it makes it impossible to compare numbers because you're comparing to an old definition to a new definition. And that's exactly what the BLS has done here. Now, I don't know if they do this every year like this inflation guy says in his podcast, and actually, I'll put the link down there to it. It gives you some weight to it. But these changes don't allow you to make the comparisons that you need to make. Now, this inflation guy basically goes through and says, oh, but, you don't understand. We had this COVID thing, and I agree. There are special causes out there associated with data that you need to account for, but I don't think you need to change the operational definition to account for those changes, because then still the relevance of previous measures, then now you're starting from square one with a whole new measure and an operational definition. So that's my issue with it, and I really am struggling with the defense of it. And I was actually, they're talking about conspiracy theories, and maybe it is. But even after listening to that podcast, I do believe it's going to affect dramatically what happens on Tuesday. And I'll be the first to admit when I come out again next Friday and say I was wrong if this thing doesn't come out much lower than the previous reads. Now, they aren't going to give you, the old operational now, if you're working with data, as I have, you always keep the old measure, even if you have a new measure, for those comparison purposes. But, the government's too good for that, apparently. And I just found it very bizarre that the inflation guy is, backing these changes. Oh, it happens all the time, all these types of things. So you can listen to the podcast. You make your own determination. But my belief is that on Tuesday morning, before the markets open, when they release CPI, that number is going to be much lower than people expect. And so there you go. We'll see what happens in association with it. And, I don't really have the time to work in all of the data. There's so much probably I don't know behind the scenes, but the changes that are made that you can look at the, from the BLS, walking through what they're changing and everything. My belief is that they're trying to lower the number. Call it a conspiracy theory. Call it because we had COVID, and now they're just trying to smooth it out a little bit, or whatever the inflation guy says. Go for it. But I believe that when they release that number, it's going to have a significant impact. That's my read. I actually will be playing the market in association with it. And again, not a trading call. I'm not making recommendations or anything, but I do believe that the markets are going to respond to that short term. Now, they may gather their feet as they've done before and say, oh, well, wait a minute. It's lower because nothing's really changed. There's no significant change in the economy or anything like that. All they've done is manipulate the number, in a certain way. And it's manipulation. They may not like that word, but that's when you change the operational definition, it is manipulation of the number. So anyway, that is kind of my opening, I guess, is to look for that on Tuesday. And if, what will the read be? I'm not sure. We'll go through when we look to next week, and I'll just say I think it's going to be X number. So this past week, we had, that's the upcoming week. Let's look at the previous week. All right. We had balance trade. The main thing was Powell came out, and he came out pretty benign. He didn't really, he wasn't as hawkish as he's been, and he has tendency to do that on occasion. But I think the next, and the market responded. It went up. Let's see here. I think I brought it up. So let's see. The Dow Jones would have been, what time? 3 o'clock on Tuesday. So 3 o'clock on Tuesday. This is a 30-minute chart. 3 o'clock on Tuesday, after he had spoken, you could kind of see that the market was, went on a winning streak here, so to speak, and finished the day up, whereas it had gone down. It returned, went back up, and then everybody woke up the next morning and had second thoughts about what Powell said. And there are other factors, but not anything more significant than the Fed chairman talking about what's going on. But then you had, let's just cover the mortgage rate went down slightly from 6.19 to 6.18. Okay, great. And then you had all these, the rest of the week, you had all these Fed chairs come out, or Fed members come out, and they all were hawkish, and we're going to have to keep it at, we'll have to raise it to 6% and, bankrupt the company or the country, rates such as that, and keep them for a long time. So I'm not realistically expecting these guys are just, anyway. But they were very hawkish and kind of talked the market down a bit. And then Friday, we got the Michigan Consumer Sentiment report. It came out a little bit higher than the consensus was, 65, and that was kind of the week. And we ended up a little bit lower. It was a mixed bag of stuff. It just was kind of a nothing week. And I think everybody's waiting for the CPI number to come out on Tuesday. So that was this week. We'll take a look at next week. It's going to be primarily it's going to be all about the CPI. So you're going to get that on Tuesday morning, right at market open. And, I'll cover the mortgage rate because that obviously is significant of how the economy's doing. Retail sales, we're starting to see it weaken some, so that might be. But let's be honest, the CPI is the only thing that's going to make a huge difference, my belief is. And then on Thursday, we're going to get building permits. We're going to get PPI. But everybody's going to be recovering from the CPI report on Tuesday morning. It's the most significant thing. And if I'm correct, I'm not saying I am, I believe this thing is going to print much lower than this 5.7% core. Now that's without food and energy, and the inflation. This, I think will be in the fives. You're saying 6.2, easily in the fives. Core, maybe five. From five, and their consensus is five and a half. It might even be in the fours, the high fours, something like that. And if that happens, then at least on Tuesday, you're going to see the market take off, and then maybe by the afternoon or late morning, it might reverse itself, because everybody's going to, we have to be honest with yourself about some of these numbers. So that's kind of my expectation. If somebody put a gun to my head and said, you need to predict what's going to happen, I expect much lower than expected, because of the changes that the Bureau of Labor Statistics has done to the CPI definition, that this thing is going to be much lower, and the market's going to react initially. And not something I'm going to hold on, but I am definitely going to play it. I'll have a safety net in place, but not enough to be able to get the rip if it goes upwards. Now, if it goes higher, then I'll be first of all, I'll be shocked, and second of all, the market obviously will react very negatively to that. So there you go. That's looking for a prediction. I tried to look at both sides of this, as far as the CPI and the new calculation, everything. But my expectation on February 14th is you're going to get a Valentine's Day gift of much lower CPI. That way the Fed doesn't have to work as hard and badmouth things and all that. Okay. American Association of Individual Investors. Now this changed quite a bit. Now, historically, 37.5% bullish, 31% bearish. Look at this, 10% down from the previous week, virtually 10% down, 9.6% to 25%, which is even lower than the historical averages. So we're starting to get the feeling of a lot of greed, those types of things. You look at the fear and greed index, we went from extreme greed, we were up there, down to just greed. And, my expectation is that the market will sink lower a little bit, but we're still not going to go back. Much of the talk about, a collapse in the market, 20% or something like that, in the immediate term, it started to go away. Now that may mean that it's then will happen, when everybody gets on one side of the boat. But my expectation is this number will probably work its way back down after we'll get an extreme greed. If we get the numbers I think we're going to get on February 14th from CPI, and then I think it's going to start reversing itself. So that's kind of my expectation. Was whether that plays itself out or not, I don't know. So looking at some of these other things, you could see go to daily, reset the chart. It's kind of hasn't moved much. The Dow Jones, you look at SPY, in the last 5 days, we look at the week, I think it might have been slightly down from the previous week. 10-year is a little bit worrying. Now it's starting to make its way back up. It gets over 4%. All bets are off of my mind, but we've got some areas for it to go through before the 10-year yield gets above that. And this will obviously, if that goes up, then that's going to affect a lot of the other measures for car loans and housing. It's a good harbinger of other rates. The dollar, another one, recovered, came up, hit my line here, my resistance line, and just kind of hung out up there the whole week. So we had this, what they call them, the three white soldiers, if you're into candlestick tea reading. But then it hit the wall, stopped. You could tell it hit this resistance area that's been everywhere for a long time, so it's going to have a hard time getting through there if it's going to continue to go up. As the DXY and the interest rates and the 10-year go up, you can expect the markets to go down in accordance. Now, the CPI comes out, you expect then the 10-year and the dollar to go down. We'll see what happens, at least initially. VIX was up on the week, but you can see it spiked up on Friday, and then it got beat back down close to 20 to 24, I'm going to say, is kind of a no man's land as far as the volatility goes. Gets over 24, and now you're starting to talk higher priced options and things of that sort. So what else do we have here? Put call ratio now starting to make its way back up. This reading would indicate that, people are getting more pessimistic again, not here, but they're and my expectation this may go up as the week goes on. There might be an initial drop, and then it'll start to go back up. I think we're due for a correction. You look at something like Tesla. Look at that's an amazing. Maybe the chart doesn't do it justice, but from 101 to a high hitting the 200-day moving average at roughly 213. Then 3 or 4 weeks. So you'd been love having this. I played a little bit of this, made some money off of it, but I wish I would have just gone all in. But you didn't know, right? When you're down here, you're looking at 90. So it's so volatile as Tesla. So anyway, those are some of the things that I wanted to cover this week. And again, I don't know what's going to happen with the CPI. Don't take it. You research it yourself, determine if it's something that you want to play. I am. It's not a recommendation. It's just I'm looking at the change in the measure. I'm expecting it to have, because we're not doing a 2-year average, doing a 1-year average for whatever reason it might be, that this number is going to paint much lower on Tuesday, and at least initially on Tuesday, my belief is the market's going to shoot up. I'll wear egg on my face gladly when we go into next week. I try to look at all sides to be fair, but I've looked at data and organizations before. It's not market data, and people can hit me on that. And again, there may be something I'm completely missing here, but I don't know what it is. And having worked around data, some of the things even that the inflation guy said just don't ring with me. Very true. Again, you change the operational definition, you change the measure. And in this case, the measure, if it's the way I read it, will be, you'll see a year over year much lower. And the inflation guy didn't make a prediction at all. He just kind of left it. Well, it might go up, might go down. I'll put my neck out there, and we'll see what happens. Anyway, that's what I wanted to cover this week. And remember, there is always a better way.